Listen, you go through 500 years of history to recognize patterns. My belief is that power comes to those that can do three things. One, recognize patterns. I don't care if it's in music or it's entertainment or it's in business or it's financial stocks, the financial world. If you can recognize patterns, you can take things that look like chaos and turn into something that you can predict and begin to perhaps anticipate. And if there's one power in life and in business, it's the power to anticipate. Leaders anticipate, people that lose tend to react. And so we want to see if in this conversation, we can give you a broader picture of where the world is and where America is. And more importantly, the why we are here. Because if you understand the causes, the driving forces that make something happen, you're able to recognize those patterns, but also do the second thing, start to utilize those patterns, i.e. to protect or to grow or to expand. And the greatest masters in certain areas actually develop a third skill, which is the ability to create patterns, new ways to make things happen, to turn things around, to make a change. And Ray, you've done this your entire life. And, the patterns that reoccur over and over, we often call cycles. And you're a student of cycles. And one of the things you've done is built principles, these tools that help you recognize these patterns and show you how to really maximize or utilize them. Would you be able to start out maybe at the 30,000 foot level, even before the book, and tell us a little bit about your journey from the beginning days as a caddy to beginning to recognize patterns and some of the places that you missed along the way and why misses were so valuable? I know, you shared with me, I think it was in the early 80s, where after building your company, you were so successful and it looked like you lost almost everything. You had to start over. So I think it'd be really important for people to understand, before we talk about just the world and the country, the understanding of these patterns and how they can give you the ability to create a greater quality of life for yourself, for your family, for your company, et cetera.
When I was a kid, as you point out, I caddied, I delivered newspapers. I did a bunch of jobs when I was a kid. At age 12, I bought my first stock. I was caddying. The stock market was hot at the time. People I caddied for were talking about it. The first stock I bought was a stock by the name of Northeast Airlines. The only criteria I had was that it was selling for less than $5 a share. I figured I could buy more shares, and if it went up, I'd go more money. That was dumb. But the company was about to go bankrupt. Another company acquired it. It tripled in value, and I was hooked on the markets. So I was hooked on the markets at the beginning of 12, and that's my game. Okay, now fast forward. That's 12. At 22, 10 years later, so 1971, I was following the markets, and between graduating from college and going to graduate school, I was clerking on the floor of the New York Stock Exchange. And in that intervening period, there was a lot of aspirations, a lot of desire, to go to the moon, to eliminate poverty, to make equality in the United States, and so on. So in that early era, when there was Kennedy, and that made me an optimism. And then, but during that 10 years, the fact is that there was a lot of borrowing of money, a lot of deficits. Back then, gold was money. And money, as we know it, was like checks in the checkbook that would go get you the gold. You can turn in your paper money for gold, but gold was the real money. And because the United States had borrowed a lot more money than it had, it wrote a lot more checks than it had gold in the bank. And so on August 15th, 1971, when I was clerking on the floor of the New York Stock Exchange, I watched on television as President Nixon defaulted on the obligation to pay gold for the cash. He went on and he said, you won't get the gold. And of course, he didn't say it that way. He said it in a way where it sounded like there were speculators and so on, and he had to do it, but he didn't get the gold. And so on the floor of the New York Stock Exchange, I walked on the floor of the New York Stock Exchange, and I thought the market was going to go down a lot because, after all, this is a big crisis. The money, as we know, it ends. And I couldn't have been more wrong. It went up a lot. And what happened was, I never went through a currency devaluation before, because in my lifetime, there was no currency devaluation. So that's the first time it happened. So I went back and I looked in history, and I found the exact same thing happened on March 5th, 1933, except rather than the television and Nixon, it was the radio and Roosevelt, and he made the exact same announcement and had the exact same effect. And at that time, I learned two big things. I learned that first, that many things that never happened in my lifetime seemed surprising at the time, and that I needed to study things that happened before my lifetime to understand them. So when certain things are happening, like right now, there are certain things that have never happened in our lifetime before, but happened many times in history. So in order to understand them, just as you said in the beginning, I need to understand the patterns, and even more than the patterns, the cause and effect relationships behind the patterns. So that mistake taught me that I not needed to understand history. And there was, and each of the mistakes has taught me. I made a big mistake in 1982. I won't take you through it because it just probably take too long. But in other words, a big mistake in 82 when I calculated that foreign banks, American banks had lent more to foreign countries than those countries were able to pay back. There was a big debt crisis. I anticipated this debt crisis, Mexico defaulting, great, okay. But what happened is the economy, and I expected there would be a terrible economic situation. And you know what happened? The Federal Reserve printed a lot of money and it had the same effect.
Go bet
So
against.
I learned these, you learn the lessons. Okay, that's those lessons that I learned let me study the 1929 to 32 period, which allowed me to anticipate the 2008 financial crisis and make a lot of money there when most people lost money. And right now, what's happening now has let Bridgewater and us to make a lot of money while the markets are behaving badly now, because the same thing happened in the past. So yes, studying history, learning the lessons, writing them down, modeling them.
The three things that are happening today that have not happened so much in your lifetime, the overspending, maybe we can touch on those three now to help people really understand just those three principles that are probably most practical for people to notice right now.
The three are creations of a lot of debt and the printing of money by the central bank to pay for it. A lot. Okay, that's number one. And you're seeing
you're spending more than you earn is the bottom line, right?
But you can't spend more than you earn. That's you got it. You're saying so well. Just a basic law of economics. You can't keep spending more than you earn. Okay, because then what do you do that? You create it on debt. And debt has to be paid back, and one man's assets are another man's liability. So if you've got debt, somebody's holding that expecting a real return. And when you don't give them a real return, like we're not giving them the real return now, then they sell the debt and interest rates go up. And then the central bank is in a bind because they have to print more money or they have to curtail it because the day of paying back comes. The only question is whether you pay it back in hard money or deflated money. So think about it. It's like borrowing. When you borrow, it's like borrowing stuff. We think of it, it's a certain number of dollars that you borrow, but think of it, you're borrowing stuff. And when you borrow and spend, then you can spend more than you earn because you borrow. That makes the difference. So you spend more than you earn. And that means in some point in the future, to pay back, you have to spend less than you earn.